Hey guys, Doug, the retirement guy here. We have an update on the Granite Shares weekly dividend ETFs, all six of them, to give you kind of an update of where they're going, what's happening, especially in the troubling times that we're having now. We really want to take a look at how our investments doing and going forward with that. Before we get into the video, I got a big shout out to all of our Patreon supporters. You guys are awesome. Without you, we could not keep this channel rolling like we do. Also, want to thank all the new subscribers out there. You guys are setting records. We just broke 20,000 subscribers. Thank you, and thank you very much for enjoying the show. And all of our past subscribers, welcome back. Again, without you, we would not be where we're at today. Let's get into today's video, Granite Shares Weekly Dividend ETFs. Notice to all viewers, the past performance does not guarantee future results. The information provided in this video is for educational and informational purposes only. It should only be considered financial or investment advice. Always ask a financial advisor before making any major investments. So let's update you a little bit on the purchase that we've done here. The real challenge here was to see if this is a good investment or a bad investment into the Granite shares. How are they going to handle the weeklies? And so far we've been, I'll say, kind of mixed on this answer, and we'll show you here a little bit. But to also give you, we bought 5 funds on June 2nd. We bought the 6th fund on July 31st when it first came out. We invested $1,000 per fund with a $6,000 total investment. All of the funds are weekly payers, and this is why we're doing this, because we want to watch how are weekly payers doing, what are they going to do. And we have basically set up a goal that we wanted 15% average income return from the funds, and we wanted to have a growth of 5%. We didn't think that was big, hard targets to hit. So we're really going to watch. These are the goals. If we can blow them out, 15% on most of these are going to be easy to do, but on the growth is questionable. So let's get into the funds and break it down for you. So first off, growth or value of the funds. And when we take a look at this, and we're kind of giving you a comparison to last week to this week, and you can see every one of the funds are actually down this week. And when we take a look at it, everything is actually in red on Granite shares when we talk about growth. We know these things are, these are yield boosts. So what they're trying to do is get 2 times the return of the standing stock of Tesla, Nvidia, Bitcoin, coin. So they're trying to get 2 times the reaction. Well, when you try for 2 up, if something goes down, you're going to normally get 2 down. So these are the problems with yield boosts when you're buying an individual fund or stock, is that when you're trying to do it on one, you're liable to what that fund will do. But we take a look at everything is I call fair priced under that $20, pretty much under about a $20 price point. But overall, COYY is our lowest one at 6.29 for the week. And then we look at the TQQY is down 5.21. The only positive one that we have out there is the Nvidia one, that year to date, it's still up 2.54%. And now this fund here, the TSYY, the Tesla package, is down 65.74%. So you've lost a lot of value. So anybody coming into this today could be a positive that you're buying at basically bargain pricing at the rock bottom. But we're really get concerned with that one, saying where's the growth? Where's any type of growth? If we keep losing 3%, fund will be down to virtually nothing. So overall, if I have to give a winner, I'm going to give it to Nvidia's NVYY because it's still holding its year-to-date growth. But at the other side of all these things, if we don't see some good positive distributions, I don't know if I'd be on any one of these, even though I've talked about the NVYY as a whole. So let's take a look at distributions. And when we look at distributions, again, all of them are down from the previous week. Now, COYY, the coin one, is the highest paying at 69 cents per share per week. The next one coming in is going to be NVYY, the Nvidia, at 49 cents per week. So some decent numbers there, Even the Bitcoin one, XBTY, that we just put a video out on, still pay 43 cents. So dividend wise, these guys are doing great numbers across the board. And when you take a look at the distribution rate, now these funds are not been out for a full year. So this distribution rate is a computer calculated number directly from Granite Shares. So this is not using our computer. This is using their direct reports. And you can see COYY is 179% distribution return. The Tesla one, 139%. NVIDIA's program, 99%. The Bitcoin one at 100%. These guys have got some serious distributions. And it seems like Granite Shares is very, very focused on distributions, but they're losing the growth picture. So they're getting the boost on the dividends. So when they're getting their boost, they're making money. But the problem is they're not getting that growth. Now we take a look at the return of capital. This is something new that we're able to add to the Granite Shares now. And look at the return of capital numbers. And I'm impressed with this. I will tell you guys straight out, I'm very impressed with this because we watch this heavily now with the yield max and the round hills and all that. When you're looking at these, all of these are below 100% return of capital. So yes, you're going to pay a little more taxes on some of the distribution, but as a whole, they're not digging into their pockets to pay you back any of their return of capital. Okay, so they're doing some advantages. They're doing some strong things to keep you in the strong dividends because they're earning dividends, not just paying money out of the pocket. Now, I know we have a video on the return of capital, so if anyone wants a question, do you understand return of capital, which we get, and that's okay. Everyone's allowed to make comments. We have a strong package of explaining return of capital. But as long as we're keeping that 100% and below, I'm positive with these guys. These guys are doing the right thing across the board. So distributions, 2 thumbs up. You guys are giving us some great money. You're doing some positive there. COYY by far is our #1 in distributions as of distribution rates across the board, and it's the lowest return of capital, positive. Now remember, that video we just put out with XBTY. This is strong right now because a lot of people are asking, where do we turn from here? Where do we go from here with ULTY doing such a bad number? If you guys are all interested in that, these are our alternatives. So we look at the assets under management. This is another thing that we watch heavily. If you're going to have 100% return of capital, what happens with the assets under management? If it's realistically you're taking money out of their pocket and paying you back, taking your money and doing it, we're going to watch the assets under management slowly decline. Now, if they open up more shares and start building the assets under management, that's one way of doing it. The second way of doing it is doing a reverse split. So where you take the price of a share, you double it, okay, and your value is worth, but you lose shares of your fund, which is a bad thing because you can't grow as fast. So when we look at this right now, I sit down, and the first one I was really concerned about was TSYY, the Tesla program. The fund continues to drop. The value of that fund has dropped down to $8.28. This is one I can tell you I'm excited about, but I'm nervous about at the same time. At $8.28, you can buy so many shares of this. It'd be crazy. And you're getting 21 cents per week dividend. So this is, again, I hate to keep using them, but this is a ULTY setup. $8.28, paying double what they pay, 21 cents. It's 2.62% of the stock value is paid out as a dividend. So that's a huge return on your money. And then, but look at the assets under management. It is the largest one out of the package at $124 million in investments. So I'm not worried about this one going to a reverse. I don't worry about this one having the money. We're going to keep an eye on this, but $124 million out there, you can do a lot of damage with that. And I think once they get the Tesla thing straightened out with the media, and people starting to like Elon again, this thing will take off and rocket it. The ones that scare me the most is the TQQY, that they're only down to $5.46 million and invested at $18.20 share. I would expect them to start rolling some big shares out and start building that number back up to get up to where they need it, because you need assets under management to generate the dividend income, to generate this side of it. So if you don't have that, you're not going to get your dividends. If you're not going to get your dividends, you're not going to get investors. And if you don't get investors, you're not going to have a fund. It's the bottom line, the way you play it. We look at the other things. What's the percentage of their dividend being paid out? TQQY is at 0.95, just under at 1%. YSPY, same thing. So those are the two funds I'm really watching, saying they're going to do something with. They're going to have to do something, either release more shares or do something in that category. The other ones I look at, the NVIDIA and XBTY, they're both in that one, just under that 2% dividend thing. What does that number really represent? It's how much of the dividend are they paying from the share price. It's basically telling me that it's either underpriced for the amount of dividend you're getting, or the other question is, can they continue paying this if you're paying this certain percentage of the dividend? COYY is the one that throws me at the burst. At 3.35% of the stock price is just ridiculously high, and it scares me. So it's either I see that they're going to cut dividends onto it, which normally what happens first, or they're going to try to figure out how to boost their share price, but normally dividend comes first. Again, why we ask the assets under management, because that means so much. And we'll probably put another column in here to see what it was this week versus next week to give you guys a better example of what's going on. So overall, assets under, I'm very comfortable when you're into the double digits, the 38 million, 79 million. I do not like when they're down to single digits, 5 and 7 million. Kind of warning signs for me on that one. The return on investment. Now, this is a huge one that a lot of people, again, don't always understand, and will help you here with this one. And what it is if this dividend stays right where they're at, and normally what we try to do is use the average of where they're sitting. But with the new dividend into the current share price, it tells you that if you bought, and we'll just use the very first one, if we use Tesla, okay, and if we use Tesla paying 21 cents and we bought a share at $8.28, realistically, in 38 weeks, you would have your $8.28 back. 38 weeks, you'd have all your money back from what you invested. Plus, you still have the shares. Okay? So this is why you turn around and say, this is a cash cow. So basically, within 3/4 of a year, you have all your money back to take that money from dividends to either reinvest it, do what you want, or create this as your income cash cow. Take a look at what COYY does now. Now we have a better understanding of it. Paying 69 cents on a $20.60 share in 29 weeks, or basically half a year, you would have your entire investment back in your pocket. That's not saying that the price of the stock goes down. That doesn't say the price of the stock goes up. That is irrelevant to what we're dealing with here with return on investment. What we're really watching is, did the dividend continue to average 69 cents per week? If it continues to average that, then in a half a year, we have our money back. And the bonus is, if the COYY price doubles, your net value is worth twice as much. And you have nothing invested into it because you took out your initial investment. Now, if it goes down to $10 a share, again, you have all your investment out, and you still have a stock that's worth $10. So it's kind of interesting how we put that return on investment. We'll probably do some little more research for you guys to give you some better understanding, because this is how you can play the market and not have to worry about the funds going up, down, sideways. What you're worrying about is the dividend income. What's the dividend income doing? And our retirees, like myself, who live on dividends, I live 100% off of dividends. I have no other forms of income, and I'm living off of dividends. I'm watching the dividends day in, day out, but I'm not watching my total balance. Okay. I'm not concerned with that because I have funds that are designed for growth, but I got my funds that are designed for dividends, and that's what we watch. So this is what's really critical. Anything in my book, anything under a year is 2 thumbs up. Anything basically a year or less is 2 thumbs up. Anything over that, I got to really question, do I want to put my money into it? And that's why NVIDIA, XBTY, CLYY, and the Tesla one all have me saying there's their 4 stocks, funds to really be looking at and saying these are long-term, set, collect my dividends, watch my dividends, and get in and out, and then just let these things be my cash cows. So let's take a look at Doug's fund, the lineup. This is the fund that we basically put together where we bought every one of the funds, invested $1,000 in each and every one of the funds. And we've been basically, running this since June 2nd. So realistically, we are 2 months, almost 3 months into this. So we're going to break this down equally. It shows you the number of shares that we've actually, with the $1,000, we're able to buy. So we have $6,000 invested in this. Our fund value now is $5,555, or $444.89 loss so far. That's a 7.41% loss. Our goal was to gain 5% in 12 months. So we are way off our goal. We are now, for basically, I said 3 months into this. That gives us 9 months left to go. We're going to have to pick up at least 12 percentage points in growth. So I'm not pleased right now with the growth of the Granite Shares funds. The dividends, though, we have collected $1,146 in only those 3 months, or 19.11%. Our goal is a 15% growth in income from dividends, and we're already at 19%. So that one there, we're definitely going to rocket this thing out, and we're going to actually end up doing what I hate doing, but it's really the proper way of doing it, is we're going to take some of these dividends and pour them back into the fund value to balance out the difference, the losses. Because when we take a look at it right now, if we take the loss of the value of the fund plus the dividends, we actually have made 11.69% in 3 months. How good is that? It's okay. 11% growth in 3 months. We're talking, 44% growth on a fund or an investment. Very nice portfolio. I think that's a strong piece to talk about, 44%. But this is what I always explain to people too, is don't go out. I call this the Vegas answer. And I talk to different people all the time about this, and especially on our Patreon, where they go into the chat. So we talk with them live and go with theirs. Everyone comes and talks to us and says, oh my God, I am making 100% on my Tesla fund. I'm making 100% on this. It's like Vegas. You go into Vegas with so much money in your pocket, and you put that into the machine. And when you walk out, you ask somebody, how'd you do? Oh my God, I won. I won in Vegas. Oh, it was great. What did you win? I hit on the slot machines. I hit $5,000. No one ever asked you what was in your pocket originally. And the guy who walked in had $10,000 in his pocket. So he won in Vegas. Give him credit. But Vegas took $5,000 of his money. And that's the same thing here. I can tell you I'm making big dividends. I'm making 20% in 3 months. Okay, that would put me at 80% for a year. But the truth is I'm only making half of that. because you have to look at your total value. And this is what this time right now, I'm telling you right now, the rest of August, September, and we get into October. October's always a bad month in the stock market. And this is where you need to sit down and really evaluate yourself and say, am I in for the long haul or am I in the short haul? I go back to, and I know we spent a lot of time on this, but I go immediately back, look at the whole Tesla market right now. It's only worth 700. We've lost over $300 in stock value. We've only gained $280 in dividends so far. So we are actually down 1% in our Tesla fund. Is that a fund I really want to be in? And I talked to you about that, this being a cash cow, this being a great fund. I'd rather take all the funds that I have in Tesla and put it down in COYY, the coin program, because that one's grown 14.5%. Even though I'm losing money in the stock value, the dividends are so big that I'm actually gaining. Same thing with NVIDIA. We're losing money on our value, but we've gained so much in dividend growth that we're sitting great. So long term, I'm in this for a long term. I'm in this for a year with no questions asked. Short term, don't even look at the negatives across the board. But we start evaluating, saying, do I really need to be in a fund? What's the long term? That's what we're really trying to point out to you guys. So we'll give you one more thing, and we're going to give you Doug's top 5 picks, what to look for. Number 5, YSPY. The SPY is return of 2 years, 19-cent dividend. It's down 22.95%. It's not a big strong one to me, so it's why it's number 5. Number 4, we just talked about this Tesla. If you're new into this, probably a great buy. If you're invested into it, sit, hold, or balance out your fund, lower your value on number 4. Number 3, COYY, the coin. In a half a year, return on investment, huge. 69 cents dividends, man, that is huge dollars coming into you. It is down 18.25%, but that's only the growth side of it. You have plenty of dividends to help cover the downside of that. Number 2, XBTY, the Bitcoin, return of 1 year, 51-cent dividend, very strong dividends. It's only down 10.29%. That's how I got number 2 over to COYY. Little smaller dividend, but it's not down as much. So I tell you, this is another great play. And at number 1 is NVYY, the NVIDIA. Roll is 1 year, 56 cents dividend. It's up 2.54 year to date, so it's holding its own. So that's why NVYY wins. If you want to pick which ones would I do, I would put money into NVYY first, then XBTY, and then COYY, and that's where I would stop at. Guys, it's Doug the Retirement Guy. I hope you like this information that we got. Give me a thumbs up. If you're not a subscriber, don't know what you're waiting for, hit that subscribe button, join our unique community. We give you the stuff on simple, basic information and the way my parents always gave it to me. Also, comments. If you guys have any comments, put them down below. I'd love to hear what you guys have to say and where we're at. And finally, if you can support the channel, get into that description, hit that Patreon tab, and join the family over there. Get that information as I showed you that we give you on YieldMax or on the YieldMax products every Wednesday morning to help you guys out. So we'll tell you next week.